No, 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 no! If I'm gonna get up at 5 a.m. for my 21-year-old trophy wife, at least let me talk about the good things. At least let me look at my portfolio and let it be green. Now I have to talk about the shit show that the Bears put together today. You couldn't wait till after December, after Christmas. Welcome to the show. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day across the board. What we really saw was a flight to quality into the biggest names with the best earnings power, the best balance sheets, and that meant market rotated out of the broader market into names like Google, Meta, Amazon, Tesla, Walmart, Costco, Coca-Cola. Defensive names too. We saw utilities here outperform, as well as real estate on the back of what happened with yields. But again, it really was just a quality trade. Nvidia up 4% ahead of its earnings. Some of the quality names here in software. And then we also saw Apple and Microsoft again outperform the broader market, relatively speaking. Maybe not its peers, but outperforming the broader market. And it goes to show the quality rotation we saw in equities. And that was mostly on the back of investors assessing news. Vladimir Putin, the Russian president, signed a revised nuclear doctrine that allowed Russia to expand its use of atomic weapons. Now, the changes mean a large-scale aerial attack could prompt a nuclear response, and any attack by a non-nuclear state that is supported by a nuclear power will be viewed as a joint assault. It comes just days after President Joe Biden gave Ukraine the go-ahead to use long-range missiles to strike inside Russia. Ukraine carried out its first such aerial attack in a border region on Tuesday morning. As a result, guys, we saw a flight to quality. Now, equities were positive on the day, but the overall news we got with regards to what Putin did, we actually saw equities have very, very steep losses into the day. At some point, some sectors that finished green were actually red as much as 1.3, 1.4%. So we saw very steep losses, actually kind of capitulation here towards the end of the day. However, the market parred a lot of those losses because we did get some news of that escalation easing towards the end of the day. And then we saw markets rally onward and upward. And in fact, we went from pretty much every single sector red on the day in the early morning before 12:30 to about half in the green, half in the red, with the S&P 500 returning 0.34% on the day. The best performing sectors were, tech names, XLK, XLC, right? These are the highest quality, the big names, the Magnificent Seven names. And then we also saw the defensive trade. XLU was up there 0.57%. XLP was positive and XLRE, but that really had to do with the situation we saw in yields. And we'll talk about that on the charts. And the market really shunned financials, energy, healthcare, materials, and industrials. So anything that could be affected by Trump tariffs, or where there's extremely low quality names, the market didn't want anything of that. If it had high debt, the market didn't want anything of that. If it was associated with commodities like energy, the market didn't want anything with that. Simply because while oil can be a geopolitical hedge, in the case of Russia, that could adversely affect energy prices, the distribution, and the supply chain. And as a result, the market would much rather go into these names right here versus, these names, energy, healthcare, materials. And that's why we saw growth outperform today, particularly large cap growth, but across the size segment, large, mid cap, and small, we saw growth outperform. Core lag behind growth, but still positive across all of these size segments. And then we saw the value names, which is pretty much stuff like materials, energy, financials, healthcare. These value names underperformed, particularly large value, but again, mid cap value and small cap value underperformed the broader US core as well as US growth index for the most part. All in all, today was just a flight to quality based on the news that was, but also that did coincide with what's coming in the week ahead. Now, really quickly, before we move on to our market moving names for the day, we did see the global market do very, very well. China, very green. The ASX index actually hit new all-time highs yesterday. What was really red was just Europe, the epicenter for all of the geopolitical tension. That was very red. And likewise, they're going to be directly affected by the impacts of Russia and their decisions. And then South America, North America, fairly green. But let's actually talk about market movers apart from geopolitical news. Amos Sports, and they're the parent company of Solomon, Wilson, Artex, and other sportswear and sports gear brands. And they pretty much came out and said that Trump's tariffs would prompt the company to raise prices for all of its sports equipment. At one point, the stock was up nearly 8% on the day, finishing up just shy of 4% for the day. Again, tariff implications mean higher prices, and assuming volume stays intact, that just means a higher top line for these companies. Now, we also saw Nvidia rocket up 4%. Now, the stock rose because there were plenty of bullish notes from Wall Street ahead of its earnings, citing strong chip demand and Blackwell performance. Nvidia also came out and dispelled heating issues, and the stock is also reporting its earnings tomorrow. Coupled with the trade inequality that we saw today, that all meant Nvidia was up 4%, but all eyes will be on this name after the close on its earnings. Nothing else really matters tomorrow apart from this, unless a nuclear missile actually detonates, then it's all games off. Looking at SMCI, they were up 31% here on the day. Crazy price action. The stock is actually trading at a 10 times forward PE, by the way. Now, Supermicro was up like 30% because it announced it filed a plan to keep it from getting delisted, and that was very, very positive. The stock is down 77% from its record high set in March. I think it's officially negative on the year, but the fact that it's going to avoid the delisting, investors love to see that, but I would still stay well away from this name. In other earnings news, Walmart was up 3% on the day following its earnings report. The company top line and bottom line revenue estimates provided very solid guidance, but we did see a little bit of a sell-off from the highs here, and that's because the company told Reuters that they're concerned that a significant increase in tariffs could lead to increased costs for our customers at the time when they are still feeling the remnants of inflation. So great earnings report, but again, all of the geopolitical stuff, the cross-border stuff, the tariff stuff, really starting to affect stocks, the market realizing and computing what these could mean for the market. And that's why we're getting very mixed price action in the market. Nonetheless, if you tune out all of the noise, guys, what we still see is that medium term and longer term averages are very, very solid. The 20-day to the 200-day is above the 50% mark. The 50% mark is really the line in the sand between strong and weak. And what we are seeing here with the noisy 5-day moving average is continued improvement after we saw lows of 27%. However, this average is very, very noisy, and really from the 20-day onward, that's really where we should be looking at. So any opportunities we do get in this market, any pullbacks we do get, as long as the trend, which is currently intact, remains as is, you want to take those opportunities because the market is really still gearing up and is still set for us to go higher into the end of the year. There's so many tailwinds from buyback, seasonality, tax cuts, earnings, margins, everything in between. There's way more tailwinds than headwinds, and a lot of the headwinds we see is really just short-term, one-day events. But if we look at the year and now in terms of tailwinds into the end of the year, the market looks poised to go higher. But let's hop on the charts. Now, we had a very green day across the board. Equity is very green, except for the equal weight, down 0.27%. This is in comparison to the S&P 500 and the Nasdaq 100, as well as the IWM, which were up 0.4 and 0.7% respectively. We are seeing bullish momentum here in the after hours, and then mid caps were flat. The SP 600 actually did gain ever so slightly. So really it was just that large cap value part of the market, which makes up the majority of the RSP they were down significantly. And so if you were in the equal weight S&P 500, you probably had a red day. Everywhere else, you were probably flat to green. Looking at yields though, yields actually fell on the day, and that did support equity prices, especially from the lows we saw early in the morning. The dollar did fall ever so slightly, but it was virtually flat, and that actually did help real estate stocks too. So real estate stocks rallied mostly on the back of yields falling. This is actually the second day in a row that yields fell. Bond prices gained, and again, so too did gold, silver, and crude, and that was really just a safe haven trade on the back of the geopolitical news. And now yesterday, looking at the S&P 500, here the gamma flip zone, it has not changed, and what we're still looking at is sort of like a bottom being put in here right at the 58.70 area. Now I said in yesterday's video that yesterday's price action wasn't conducive for us to move higher. We really had to go break Friday's high. That's exactly what we did. We did not just break it, we closed above it, and now we can actually aim for the gap fill at the 59.50 area. And that would be very constructive, especially being in positive gamma. To close this gap would just mean that we open up the 6,000 level. And as it is right now, this is looking like the zone where we actually want to buy to go ahead and maybe take out those highs into the end of November. Seasonally speaking, guys, we should really come out of the lows here in November, out of this digestion period, and in the next couple of days towards the end of the week into the start of next week, we should see further momentum to the upside, at least seasonally speaking. That being said, for the S&P 500, things are looking like they are going to move higher simply because we cleared a level today, and if we go ahead, close that gap, that opens up the 6,000 level, the core resistance being in positive gamma. We buy dip, sell rips, and the gamma flip zone acted as a very strong support. Yes, we did go into negative gamma, but the bulls saw value and bought the dip. Looking at the Nasdaq 100, similar situation. However, we are back in positive gamma above the 20,560 area. We closed at Friday's highs, probably a little bit higher ever so slightly, but inconsequential. And like the S&P 500, we've put in a low, a higher low you could actually say, and now we want to go close that gap fill and aim for the 21,195 area. Looking at the RSP today actually posted a green candle, but still a red day. So that goes to show the bullish momentum we saw, but also the massive gap down, right? And for the RSP, I think based on the geopolitical tension we're seeing, we're going to continue to see a flight to quality as well as defensives. And that means the RSP could actually trade flat to sideways, potentially down from here. Maybe we go ahead, close this gap before we actually move higher. And that's because we're going to see the S&P 500 outperform, the Nasdaq 100 outperform, and the RSP underperform. So maybe for the RSP, for those of you that want to get long, maybe have multiple positions, multiple buy zones. Your first buy zone can be right here. Your next buy zone can be at this gap fill, and your third buy zone can be here at the 176 area if we get there. So if we don't bounce from here, your next zone would be there. And if we don't bounce from here, your next zone to buy would be in this area right here. Either way, do expect the cap weighted indices to outperform, especially if Nvidia beats and raises tomorrow, particularly on the guidance side. I think just with this geopolitical tension we're seeing, we're definitely going to see a flight to quality. And that is the real, the big tech names, the Nasdaq 100. The market's going to position themselves into these names because they have a ton of earnings power, and incremental input costs aren't really affected by the geopolitical situation in aggregate. There'll always be some residual effect, but compared to like an industrial or a healthcare company or an energy company, it's much, much different. And then looking at the RTY, the IWM actually outperformed really well today, up 0.74%. And we did see a move lower into the put support. However, we saw buyers come in a very big way. This is a steep candle. It actually reminds me of the candle we saw right here in mid-September, and we actually rocketed up after coming down. So, we put in a low, had a massive wick, and that was the signal to go long. And that has been a great long ever since, making higher highs, higher lows into 52-week highs right here. Now, the Russell 2000, we're seeing much of the same strong buying momentum. If we actually go on the one-day chart, we can see the capitulation right here, and then just a strong move breaking the highs above the put support zone and all the way to the middle of the put support. What do we want to see tomorrow? We want to see a move upward into the gamma flip to the upside, or we can then make the next move and go to the downside from there. But this momentum, let's keep at it, bulls. The bulls did exactly what they needed to do, and that's take the IWM off their lows back into the negative gamma zone. That's where we are right now. This is normally where we see a lot of volatility, guys. And from there, let's aim at next zone for the gamma flip and then make the next move from there, if that's onward and upward into positive gamma, or if we actually reject the gamma flip and then continue the churn we're seeing in this area right here. Anyway, these zones are super good right now. I love trading these zones. They just offer great areas to buy, and they're super accurate. And then all things considered, looking at gold, guys, gold did come down. If we look at the year-to-date chart, right, gold did pull back quite significantly, but all in all, this still looks very strong. And like the higher low we're really looking for gold is above this line right here. I mean, this is very linear returns, and these lows are virtually inconsequential because there wasn't much of a base being built. This is really where the base was built. And I would say that right here, if gold pulls back into this area or lower, that could be a problem. But from what we're seeing right here, gold looking very constructive. And I think gold is going to go take out its highs into the first and second quarter 2025. I actually have a 3,000 gold target into 2025. Silver, very much the same like gold, although the ride is much more bumpier. Gold looks technically sound. Silver actually making some lower lows, relatively speaking, to these lows right here. But all in all, guys, I think you want to be a bit wary with this geopolitical stuff. Keep holding, keep buying any dips we do get. We have a couple more days of churn into November before we move into the seasonally bullish part of November and December. So in the S&P 500, that means you want to be buyers of dips here at the gamma flip if you haven't already. In the Nasdaq 100, the gamma flip zone as well. I see a lot of value in the Nasdaq 100. The RSP, I would hold off on the RSP, maybe look at buy zones in between these levels right here, but we could actually see a little bit of downward momentum as well as churn in the RSP as the market positions into quality. And then for the IWM, I like what I'm seeing, very bullish momentum, but I would really only get into this area if we get above the positive gamma, just because this is still a 52-week high, and if we break all-time highs, there's still a lot of upside left into 2025 for the Russell 2000, especially with earnings being above 25% for the next 6 quarters in the Russell 2000. So guys, you have the levels. Don't buy into the fear, buy the dip, don't trip. And diving into sentiment, this is Goldman Sachs sentiment indicator, which measures stock positioning across retail, institutional, and foreign investors versus the last 12 months. Pretty much if you're above the stretch positioning line, investor positioning is bigger than what it was 12 months ago. Below this zero line, it's less than what it was 12 months ago. And what we're seeing is significant euphoric investor positioning, telling us we are in a bull market. This has happened right after the election. And while we have seen a little bit of a pullback, yes, in the markets in recent weeks, it doesn't change the fact that we've had a bullish year, a bullish election period. We probably will have a bullish 2025, and that means sentiment likewise is bullish. And at the end of the day, the fundamentals back up the price action, not just in the Magnificent 7, but also the S&P 500 493. And while they're not growing as much as the Magnificent 7, the 493 is set to see robust earnings growth into 2025 and 2026. But more specifically, if you were to break this down quarter by quarter, we are looking at something like 14% growth in the next quarter, Q4 2024, and something like 8.3% growth in the current quarter. So all in all, we see very robust earnings growth, and this is set to increase into 2025, 2026. But where does that leave us with valuation? And right now, the US trades at 22.7 times, very expensive relative to its history. And if we actually look at where we were in the fourth quarter of 2023, and just a year ago, the S&P 500 traded at 17.3 times. We've seen extreme multiple expansion, mostly on the back of the Magnificent 7. You can't deny the fact, though, that a lot of the move we've seen in the market has been multiple driven, and that means earnings over the next 12 to 18 months is going to need to back up this multiple. But not just in the US. If we look at the US, excluding the big tech names, we've seen much of the same. While not as an aggressive expansion cycle, still a very big move up in multiples. And this has been the case in every other region: Japan, Asia Pacific, Europe ex granolas, emerging markets, United Kingdom. We've seen multiple expansion across the entire globe. And that really goes to show the macro environment we're in, as well as the earnings environment. However, that doesn't mean stocks are overvalued across the board. If you actually look at mid caps as well as small caps, there is definitely value to be had across the factor and size segment, particularly in value and core. There's still great names trading at a decent discount, and this is why I've always championed small cap quality ETFs, as well as ETFs like the Moat Index, stocks like PayPal, Google, Paycom Software. They all fit into this segment right here. And if you also look at stuff like large cap value, only trading at a slight premium to its fair value. What are the most expensive sectors? Growth. Large cap growth, mid cap growth. And you can also see right here, small cap growth trading at a bit of a premium, as well as large cap core. But the truth is, these stocks trade at that price for a reason. They have the most earnings power, the most earnings growth, and they're also just the highest quality businesses we've ever seen in the history of the world. And half of the equity market returns globally has actually come from valuation expansion, very similar to what I showed you right here. But it isn't just multiple expansion. If we actually look at dividend contribution as well as EPS contribution, as much as we've had multiple expansion across the board, we've also seen a lot of earnings growth as well. Maybe not so much in the rest of the world, definitely here in the S&P 500, and that is why US stocks have outperformed. And we are officially entering the third year of a bull market, which is typically the worst time period in a bull market. We normally see average returns of about 5 to 6%. And after 2 years of annual growth in the S&P 500 north of 20%, and especially so far in 2024, Wall Street strategists think that 2025 will see a more measured year for stocks. Now, BMO Capital came out and said that even though the year 3 in a bull market tends to be lackluster, they actually see about a 14% return from the current 57 price 100 target. They see a 6,500 handle at the end of 2025. Morgan Stanley came out and said they see a 6,700 target. And all in all, markets are really riding the tailwind of the bull market, and any dip we do get, guys, you want to buy that dip aggressively because stocks will go higher. Retail thinks so. Wall Street thinks so. But maybe things are getting a bit too frothy when it comes to sentiment. That being said, that has never been a reason to sell stocks. It has always been a reason to just hold on to the gains you have and ride the coattails of a bull market, especially into the 4th year and the 5th year, which see in excess of 10% and 20% gains in a bull market. And that's exactly what we are right now. But diving into the macro, let's look at the economy in aggregate, guys. We're going to look at the broad picture. The Fed's GDP now sitting at 2.5%. Great growth. So what you want to see, this is 4th quarter tracking estimate, and again, sitting well above the blue chip consensus. Looking at the economic surprise index, this is your bull case. This is part of the reason why stocks have done so well this year, is because economic data has been very, very good, and the Fed is cutting into strong economic data, earnings growth, and all of these tailwinds that we have that is being backed up by a strong macro picture. And when the economy is good, earnings are growing and margins expanding, stocks do very well, and the credit markets not really worried about the overall market. Credit spreads at the tightest levels they've ever been. Corporate credit not worried about a recession, not worried about a downturn. If this was the case, credit spreads would be significantly higher like they were in 2020 during COVID, but they are approaching historic lows, and this is the AAA versus the US Treasury bond index. So the credit markets are telling us you don't have to worry about a recession. The data is telling us, GDP is telling us that you don't have to worry about a recession. Things look very, very good. And in an environment like this, particularly in the macro environment, you want to hold equities. Equities do very well. Now, looking at earnings, guys, tomorrow's the big one, Nvidia. So all eyes on Nvidia. But before the open, we have NEO, Target, TJX, and then after the close with Nvidia, we have Snowflake, Palo Alto. Wednesday is the big day for earnings tomorrow, and we're going to cover it in all of tomorrow's video. So go ahead and subscribe so you don't miss a beat. And then looking at data for the week ahead, guys, we don't really have much of anything here on Wednesday. The big economic data again kicks off on Thursday as well as Friday with the PMIs. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.